Hello friends and dear investors, and welcome to our monthly series on markets and investments. As you all know that we have the highlight of the last couple of months has been the steady improvement in economic activity, and we've been talking about this through our proprietary activity indicator every month. And if we look at the data for October, we see that there has been a further improvement in the economic activity levels, and now we are just about a little bit away from reaching almost normal levels of activity levels that we had pre-COVID. And that was amply demonstrated when the Q2 numbers for the GDP were announced a couple of days back. And as we all know that the GDP for the second quarter contracted by 7.5% compared to a much larger contraction in the first quarter. But what was most important is that the level of contraction was far lower than every estimate on the street, whether it was the Reserve Bank of India, whether it was the World Bank and IMF, and even the Government of India's own estimate and that of many private economists. The final numbers were far better than anybody expected. And I think that has given a lot of confidence to the fact that this recovery has been faster than what people estimated. Obviously, there are questions in terms of, whether this is pent-up demand, whether this is a restocking cycle which is helping a faster than expected contraction in GDP and a recovery. And people will continue to look at data in the subsequent months, especially after December, to get comfort from the fact that this recovery is far more sustainable. But if you also look at the GST numbers, then for the last 3 months, we have been consistently clocking GST in excess of 1 lakh crores, which is good news. Our own view is that, buoyed by significant rural demand, massive liquidity and low interest rates, I personally believe that this economic uptick is not temporary and will be sustainable as we go forward. And therefore, it is quite relevant from a market perspective. And as we've always said, that markets are forward looking, and while people have been very skeptical as the markets keep going up, but there is definitely a fundamental basis at the macro level to feel confident that the recovery has been almost a V-shaped recovery, if nothing else. The other highlight of the month of November, obviously, which everybody talks about, is the massive inflow of FII buying that we've seen in Indian stocks. The monthly inflow of almost $8 billion in November is a record of sorts. And, that has kind of buttressed the argument that this move in the market is largely led by liquidity. Well, yes, as I've always said, that liquidity is an important factor why asset prices are going up. But we've seen it in the past that if it is only liquidity, then markets typically do not sustain. Having said that, on the other hand, we've seen that the domestic financial institutions, and I see this across the industry, that we've seen a record outflows of DIIs, almost to the order of $5.86 billion against an inflow of $8 billion by FIIs. By domestic mutual funds, there has been a net outflow. And as markets have scaled up, most investors in their own wisdom have decided to take money off the table, fearing that these nifty levels or the market levels may not really be sustainable. But my past experience of cycles tells me that this is exactly how the investor behavior is during the first rise from a bear market, where the market continues to go up. There is a fair amount of skepticism and people have a fear of heights, and they tend to take money off the table while the market continues to rally in the face of all pessimism and skepticism. And I think this cycle to that extent is no different. I believe that if market levels continue to sustain around these levels, this domestic liquidity, which is now either sitting as cash with mutual funds or cash in the hand of individual investors, will eventually have to come back to the markets. Obviously, everybody is trying to time it. The expectations of investors is that when the market corrects, we will get back into the market. Nobody knows. If we are all lucky, we may get a correction and people will get an opportunity to get back in. But if the markets do not correct significantly, I think eventually, as it has played out in every cycle, this money will eventually come back, and we will then rationalize by looking at all the good fundamental data that we are seeing over the last couple of months, whether the kind of recovery, the kind of Q2 results that we've seen will, we will try to tend to rationalize that and then come back to the equity markets again. So I believe that this kind of investor behavior is not new. Just like when we enter into a deep correction, it's very difficult to think how deep the correction will be. And if we jog back our memories back to March, where markets had almost fallen by 30% plus, it gave us memories about the 2008 crisis when the markets had fallen by almost 55%. And a lot of people were expecting that markets could go down even further from where they were, but markets turned. Similarly, the perils of trying to find a top to this market is also equally a perilous exercise, because we don't know where the markets are likely to top out. And therefore, I have this confidence that all the cash that has been raised, whether by the mutual funds or by investors, will eventually have to come back to the markets. Having said that, we did talk about the broad second quarter numbers that came out, and the surprise element was how India Inc. has aggressively cut costs, improved margins, and we've seen significant earnings upgrades cycle, which we have not seen in many quarters. And we did the same exercise with the top 15 holdings of our top 3 strategies. And what we see is a very similar trend, where the contraction in top line in the first quarter was almost 10% for our universe. This time in Q2, we actually saw a 1% growth. So we've actually seen an 11% swing in top line. In EBITDA, we had a 4% contraction. In Q1, we now have a 7% growth cumulatively for our universe. And more importantly, we had seen a big contraction, we had seen almost a 2% increase in PAT, but we saw a 35% increase in PAT in second quarter. So we've seen a significant improvement in top line, in EBITDA and in PAT between Q1 and Q2. Um, yes, there is need to be optimistic about the way corporate India has delivered, especially the larger companies have delivered, and especially how companies within our own universe has delivered in Q2. The big arguments now is this margin expansion sustainable? Well, our view is that some of that margin expansion will reverse as the economic activity normalizes, and some of the spending which corporates had cut will come back. But we are also seeing another trend very recently, which is we are beginning to see a rapid improvement in prices of commodities like steel, rubber. Oil prices are up 25%. And I think we will see some level of raw material inflation come back into the system. So the kind of cushion that we saw in the EBITDA margins in Q2, some of that could potentially reverse in the third and the fourth quarters. Having said that, I still believe that many companies will actually have a positive productivity cycle, that despite increase in some of the fixed costs and increase in raw material, I still believe that by and large India Inc. should be able to maintain the better margins on a YOY basis. And that gives me the confidence that some of these productivity changes and cost cuts are more structural in nature rather than cyclical. And therefore, I think while all of these cues on the macro and second quarter and the FII flows, etc., are positive for the markets, we all come back and investors want to understand and take a view as to where we are in the valuation cycle. So what we've done, if you look at the 1 year rolling forward P, and P is the most used valuation parameter by investors in general, we will see that we are currently trading at the average P multiple over the last several years is in the range of 15 to 16 times. We are currently trading at 20 to 23 times forward, and that's kind of causing a little bit of concern for investors that on a PE basis our valuations are now one standard deviation above the mean, and then therefore should we be worried about overvaluations in the market? My view is that every time we move about 20 to 23 times, because that's usually been an area from where markets have corrected substantially because of valuations, but this time is different from two perspectives. One is that optically the PE ratios would look higher because we may not be completely right about how earnings will pan out next year, right? I mean, because people are still very tentative about the recovery, and maybe earnings estimates for FY22 may have, and we don't know, but may have room to go up and for P's to adjust down. Secondly, we must also account for the fact that post-crisis, we've seen interest rates fall dramatically, and we've seen enhanced liquidity in the system. So if we adjust for lower cost of capital and higher liquidity in the system because of all the stimulus that has been introduced, it does call for higher PE levels. Similarly, if you look at the 1 year forward price to book, we are again trading at one standard deviation above the mean. But if you look at on a EV EBITDA basis, then the picture is slightly different. On an EV to EBITDA basis, we are still trading at slightly below long-term averages. And that tells you two things. One is that either the corporates have deleveraged substantially, right? And secondly, we've seen a significant improvement in EBITDA margins, which has kept EV EBITDA valuations well under check. And then if we look at another macro indicator, which is market cap to GDP, we are back to 93%. Usually, when you go in excess of 100% or 105% market cap to GDP, then people start to sit back and think about valuations in aggregate. But I think the jump from 55 levels that we saw in March to 93 levels currently is primarily, obviously the markets have run up, but also because GDP has contracted, right? So this year is an outlier where 2021 we will see a contraction in GDP, and therefore market cap to GDP might look a little more expensive. If you look at a similar trend in 2008-9, in 2008 March, the market cap to GDP was 101. In the crisis, it fell down to 54 and then recovered to 95, but then subsequently fell to 88, 71 and 64 because the earnings caught up. I think we are seeing something very similar. We fell from 79, 80 levels to 55. We are up to 93, and we might probably, the market cap to GDP may fall as the GDP recovers next year and earnings recover next year. But for that, we will wait and see. But the broad takeaway from valuations is that on some valuation parameters, we are one standard deviation above the average, which should make us just a little bit cautious at the back of our mind. On certain other parameters, we are still way below the averages, and I don't think the markets are completely expensive. Optically, as I said, if you adjust for the fact that we have lower earnings and higher liquidity and costs and lower interest costs, I think it does call for higher PE levels. But I think these PEs will adjust as earnings recover over the next 2 years. Finally, in summary, I would say that as activity levels improve, as earnings improve, and as flows continue to be strong, we believe that as investors, as long-term investors, we should be optimistic. And while markets may correct intermittently, but I think we are on a really solid wicket as far as markets are concerned. So with this, I'll probably end this month's market views. I think we are heading into the year end and Christmas holidays. I wish you and your family a very, very happy new year. And we will be back again early next year. There'll be a lot of interesting things for us. Hopefully, we should see more positive news on the vaccine front. Not only we've already seen that in some of the other markets, but I think in India, we should see the regulator approving some vaccines, where we can start vaccinating our population. And then we head into a very busy season where we will, everybody will look forward towards what the policy makers are thinking when the budget is presented in early February. So once again, thank you all of you. Be safe, be healthy, enjoy your vacations, and I'll see you early next month. Thank you.